DSCR loan mistakes to avoid. What's going on, everybody? It's Jeff Trevarthen, Jeff the Mortgage Pro. Thanks so much for watching today. We're going to dive right into it here. We're going to talk about the DSCR loan mistakes that you should probably try to avoid the best that you can. And I've come up with this list based off of doing hundreds of these DSCR loans over the last couple of years. So there's some of the things that I see quite often that investor makes, different mistakes as they're going into the transactions. So let's make sure that we don't make those mistakes going forward. So number one, this is probably the biggest one, is overestimating rental income. So when you're out buying a property and you're doing a DSCR loan on the property, it's really, really important to try to get the best gauge that you possibly can of getting what a DSCR loan is going to give you. Okay. Some use like the top of the market rents when you're determining the rental income. So what I like to try to do, there's a couple places you can look. Like if you're doing a long-term rentals, you can look at like a Zillow estimate. That gives you kind of an idea. That's going to give us a market rent estimate of that. But there's paid websites that are available for you. One of them is called rentometer.com. That's the one that I like to use. It's a paid subscription site. And what it does is it's going to compare similar bedroom and bathroom count rentals in your area, similar property types. So if you're looking at single family homes, you can look at other single family homes with the same bedroom and bathroom count in that general immediate area. And it's going to give you a range. It's going to give you a high and a low, and then an average of the rental income of those other properties that are in that area. So I usually, when I'm trying to make my calculations, I'm going to look at the average or the low. Okay. I never want to look at the high end. The high end, it's great because if we can get through the loan process and we can rent it out for the high end on that estimate, then that's awesome. We're going to be making more cash flow. But when we're estimating our numbers to begin with, we want to be very conservative and try to figure these out. So I say the biggest mistake that I see is trying to overestimate the rental income of the property or the potential rental income of the property to qualify for a DSCR loan. Okay. Number two mistake that I would want you to try to avoid is ignoring the DSCR threshold. So if you don't calculate the DSCR ahead of time, you may get kind of surprised with a denial or asking for a higher down payment to come in and close on the property. So that DSCR threshold is really, really important because lenders oftentimes won't go below a 1.0 DSCR. There are some lenders that will. They have some products that are available for that, but interest rates go up when you do that, and oftentimes they're going to ask for more down payment going forward. So ignoring that DSCR threshold is something that I want you to make sure you don't do when you're going into a transaction. Now, there are tools that we can use to help you with getting that calculation for the DSCR loan over 1.0. So how we can do that? We can buy down the interest rate. Number one, that's one option. Obviously, that could be kind of expensive. Number two would be that we would use an interest-only payment. So if you qualify enough for an interest-only loan, then an interest-only payment could get the DSCR ratio above 1.0. And then the other thing we could do is look at a 40-year amortization sometimes. So a longer amortization is going to make the mortgage payment lower, and sometimes that's going to bump up the payment going forward. So, or you can use a combination of all of them if you wanted to. You could have a higher down payment, you could go with the interest-only payment, and you could go with the 40-year amortization going forward. So all those things would help out with mitigating and making sure that we have the correct DSCR ratio when we're doing our transaction. Okay, so number two mistake, ignoring the DSCR threshold. Number three, not planning for prepayment penalties. So remember, with DSCR loans, they do come with prepayment penalties. Now you can choose the option that you want with them. You can go anywhere from a no prepay all the way to a 5-year prepay. The 5-year prepay is going to give us the best interest rates of the time, or a no prepay is going to give us the higher end of the rate spectrum for that particular period of time. So what I really want you to do is plan for the prepayment penalties and decide and figure out what your exit strategy might be. Here's one thing that I've seen over the last couple of years. People will go with a longer prepayment penalty because they really like the lower interest rate at the time. And in 2023, 2024, even in 2025, it seems like the rates are a little bit elevated, but there's thought that, interest rates may go down in the future. So what people might think about doing is, what's the exit strategy? If I need to refinance at some point, or if I want to sell this property, maybe I go with a shorter term prepayment penalty. Whereas if you're, planning on keeping this property for 30 years and you're comfortable with a monthly payment that you're making every month with a 5-year prepayment penalty, then just do that because it's going to be a better interest rate at the time. So kind of plan for what you want to do with a prepayment penalty going into the transaction. Don't just say, hey, I don't want a prepayment penalty because it may not always work out that way, that's the best option for you. Number 4, putting too little in reserves. So sometimes, people have been buying properties. DSCR loans require what are called reserves. Reserves is just 1 month worth of principal, interest, taxes, and insurance monthly payment. Some loans require as little as 3 months reserve. Some of them, 12 months minimum. Just depends on the lender, the type of loan, how big the loan is, credit score, all sorts of different factors are going to determine how much in reserves you need for these. But putting too little into reserves is not advised because you're not going to get through with a loan if we don't have enough money in reserves. So just remember, like, reserves are in place is a risk factor for you. It's not money that you have to put into the transaction itself. It's purely used as a risk calculation for a lender, right? So they want to know that if you don't have a renter in there for a month or two, that you have the ability to make the monthly payment still going forward. And that's why they want you to have reserves in a transaction. So number 4, mistakes to avoid: putting too little of your cash into reserves, to make sure that the property is operating correctly. And number 5, choosing the wrong property type. So not all DSCR lenders finance like short-term rentals, condos, mixed-use properties, or even some multifamily types of properties. But so applying for the loan on a wrong property type without checking guidelines first can definitely derail you. What I would say is, before you start putting in offers on stuff, talk to a mortgage lender, someone like myself who's a mortgage broker who has lots of different options and lots of experience doing DSCR loans. I can help guide you in the right direction when you're choosing the right property. I will say that, properties that I see less cash flow on typically are single family rentals. It kind of makes sense that, like, if there's, if there's no renter in there, it's 100% vacant. Whereas if you had a 2 to 4, unit property, if there's, let's say you're doing a 4-unit property and you have one person that's not paying their rent that month, or, it's vacant, then it's only 25% vacant. It's not 100% vacant. So those properties are definitely going to be better for you than single family properties. And I would try to avoid condos. There's been so much litigation in condos lately that they're becoming harder and harder to do in terms of lending on them. Oftentimes you see non-mortgable condos, which a DSCR loan oftentimes can solve that problem and lend on non-mortgable type condos. But you also have to factor in the HOA monthly payment when you're doing a DSCR loan too. And that can really throw off your numbers, considering I've seen really large numbers for HOA costs on a monthly basis sometimes in really expensive areas. So just be aware of that. So make sure that you don't choose the wrong property type when you're starting out, or you're even if you have experience when you're investing in real estate. So those are some DSCR loan mistakes that I would like you to avoid going into these types of transactions. If you would like to contact me, I'd love to be the one that helps you out with your DSCR loan financing, whether it's purchasing or refinancing these. I'm going to put my calendar link down below, so please go ahead and click on that if you get a chance. And I look forward to chatting with you on the next show. Have a great day.